So maybe Art, we'll start big picture here because I'm curious, Art, what is the latest Art Hogan target, year-end target for the SPX, Art? Where are we?
Yeah, so our target's 6,200, which doesn't seem that aggressive in the here and now, but certainly felt aggressive back in April. So I would tell you this. I think we've done a good job of going from a defensive first quarter where everyone was piling into things like consumer staples, utilities, healthcare, gold, and treasuries, to where now we feel like we have a little more clarity around trade. And I think there's some consensus that eventually, whether it's the end of July or into August, we'll know what the rules of the road are there. And we've seen a nice rotation into tech, communication services, and consumer discretionary. I think that's been a healthy rotation. I think, though, that the economic data, not the data that we've seen this week, but certainly the data that we will see in the months to come, will start to reflect some of that uncertainty, that pull forward of demand for goods by both enterprise and consumers. And certainly, we're starting to see some of the hard data catch down to the soft data in terms of the weekly jobless claims, and certainly the non-farm payroll has gone from an average of 155,000 a month down to 132,000 a month. So we're going to start to see some economic data slow in the months to come. It's just a function of how much it slows before we get the benefit of some of the tailwinds, like perhaps a tax cut if that ever gets through Congress, and a lighter regulatory touch.
And so do we just get sort of a drift from here in the short term?
Well, Julie, I think what we're going to see is that once we get into second quarter earnings reporting season, which is just right around the corner, and that will be the first time that companies will likely give us guidance for the rest of the year. Remember, the first quarter was that reporting season where it was okay not to give guidance because we just didn't know what the end game was going to be in trade, so it was almost impossible. The second quarter will be a much better tell. I think that'll give us a better look into how close we are to earnings estimates for this year and going into next. And I think that, so until then, and there's a lot of things that come up in July, right? So we've got an artificial deadline for this budget bill, July 4th. We've got a July 9th, end of the 90-day negotiating period on tariffs. So I think it's going to be one of those sort of wait and see June and July's, and then hopefully we'll work our way through some of that the tariff noise that's in the economic data now. Things like retail sales slowing because they were so strong in the first quarter. Import-export numbers falling off a cliff because there was so much pull forward in the first quarter. I think once we work our way through that, we'll likely re-engage and probably have a run into the end of the year, into the fourth quarter.
Art, one topic certainly getting a lot of attention today and being talked about, I'm interested to get your take, is dollar weakness. I'm curious, Art, to get your take why you think we're seeing that weakness, and also how it could play into that earnings season you were just mentioning. I mean, it is a tailwind, Art, is it not, for those American multinationals that are doing business overseas?
Yeah, great point there. When you think about the percentage of companies in the S&P 500 has risen to close to 50% that do more than 50% of their sales internationally, right? So, you make things in dollars and sell them in other currencies, you're a beneficiary of that weaker dollar. It certainly will start to show up in currency translation when we start to get earnings. Most investors tend to look through that as a short-term phenomenon, and the dollar certainly has been volatile this year. Came off the boil during the first quarter, and certainly has seen a downward trajectory. I think that's likely overdone, and I think at some juncture, passing a budget bill, knowing the rules of the road of the trade war, finding an exit ramp there, and certainly, as we sort of work our way through second quarter earnings reporting season, we'll probably see that firm up a bit. But in the here and now, and certainly for the second quarter, you're going to see those multinationals be a large beneficiary of that weaker currency.
Art, we were looking at yields a little while ago and looking at the fact that the Treasury auctions this week have been okay, right? It feels like it was very recent that there was a lot of concern about yields moving higher, about deficits, about the impact that the tax bill was going to have. That seems to have dissipated. Why do you think it has, and do you think that is still a potential lingering risk?
Yeah, that's such a great question. And I think that it was just 2 or 3 weeks ago where we were, pressing up to 4.68 yield on the 10-year and 5.16 on the 30-year. And everyone thought, because of the pace at which we got into those new highs, that we're going to continue on, and that was going to be it. And everything had to do with the fact that we had a Moody's downgrade, and we're increasing our debt, and we have to raise the debt ceiling, and our deficits, spending will continue for the next 4 years if this bill passes. And I think that has simmered down quite a bit. A couple of things technically that happened was the old high on the yield on the 10-year was 4.75. We didn't reach that. We made a lower high at 4.68, and we've come off that significantly. The same thing was true on the 30-year, and the auctions over the course of the last couple of weeks, including today, have gone very well. So I think that the Treasury market, gave us a bit of a scare, whether it was the bond vigilantes or just a real concern about just how we just can't balance our books as a federal government. That seems to have dissipated a bit. There was also this sort of, we'd rather invest in any place but the United States for a period of time, and I think that was way overblown as well.
So Art, when you're talking to those B. Riley clients and they're saying, okay, bottom line against this backdrop, how do I want to be positioned here? What are you telling them, Art? I know you're a fan of the barbell approach. What is the barbell?
Well, the barbell approach is balanced, right? So it's on one side, we really like this lighter regulatory touch is going to help both financials and energy. And I think that remains to be seen, but will likely be true this year. We also have been fans of industrials. On the other side of that, I think you can continue to equal weight, not overweight, but equal weight some of the high-flying technology names in the Mag 7. And I think that what we've seen has played out very well this year, into the second quarter, and I think will continue. I think that earnings growth in the S&P 500 still will largely be driven by the top 7 or 10 mega cap technology stocks that have earnings growth rates north of 30% and are still trading at relatively reasonable multiples unto themselves and to their history.
Art, great to see you. Thanks for joining us.
Thanks so much.